All right, so since we mentioned a lot of dollar blocks, I'm going to explain why I use dollar blocks and also the psychology behind dollar blocks. The first one is dollar block is the way to measure how much money can be traded into a stock before it starts to lose market caps. And the reason why dollar block exists is you have to think about the bigger guys, what they're thinking, especially when they're manipulating and they want to make money from the retails. So if you are looking at a small cap. It's if it's worth $80 million or $90 million, and some of the bigger hedge fund they can purchase the entire float and make the stock run up 100% and track the volume for retails to come in. Now the problem is if the hedge fund take too much of the float, right? And basically the entire float is his. When the stock decides to lose momentum, and lose liquidity. As I explained earlier slides, that majority of the multi-day runners or first green day volume, after around about 3 to 5 days, they will not run again for at least 2 months. So the way for them to exit the stock is going to be very difficult after the stock tends to lose liquidity. So if they don't time it well, they're holding the entire flow. First of all, they're risking offering because small cap stocks love to do offering, love to raise money. And by the end of the day, if they do offering, then hedge fund lose money. They are sending their money to the company. So they want to make money, but they don't also want to own the entire float. They don't want to take too much of a risk. That means they can only getting a certain amount of the float before they break the pattern, before they break themselves, or they're taking too much risk for that offering. And what I found out is that a certain market cap has its own maximum amount of dollar can be traded in that one ticker. So since hedge fund, let's say they have a hidden number, they don't want to exceed 30% of the flow, they don't want to exceed 50% of the flow, because if they own them all, they would just play themselves when the stock loses liquidity, and you can't really fully exit because you are affecting a hedge fund. They're affecting the stock price while they're selling it, so they will basically selling at a really low price, and their execution will be the worst that can be. So they can only put a limited amount of money, and different stock has its own market cap, and different market cap has its own dollar block. So that's what I found out. And the dollar block is based on the market cap zone, which I'm going to talk about later. And I'm going to tell you what I found out for different market cap zones. They're going to be very helpful for you to judge when the momentum is likely to shift. And the last point I'll cover will be only 100% of the flow. Now, from my personal trading experience, I've seen two tickers that one person pretty much purchased the entire float. And what ends up happening is it caused a massive squeeze, but it didn't cause any type of consolidation. It was pretty much a straight drop, 70%, 80%, because they own the entire float and they're affecting the stock price. They cannot make money from the retails. Then for that type of charts, it's pretty much you don't have an edge, they don't have an edge, and it's pretty a lose and lose situations. If they want to make money from the retail, they cannot own 100% of the flow. There's way too much risk on the offering, and there's also risk when the stock tends to lose liquidity, and there's not enough bid to support their ask. All right, so there's dollar block part two. You want to select different market caps for its own dollar block. The way you want to track it is you want to separate pretty much all of the different market cap stocks into one spreadsheets, and separate them into if the market cap are between 0 to 200 million and 200 million to 500 million, 500 million to 1 billion. Put them into different sections and to find out what's the average dollar block trades on these type of market cap. And second point is for a hedge fund to take money, or for the bigger guys to take money from the retails, or for you to be able to manage to make money from these type of tickers, you want to know how much money is being floated in the retail market. And for this specific point, you can track the most recent ticker that has the biggest volume, and use the average consolidation times the price, or you can use the average traded dollar times the volume to get the biggest amount of money being traded recently. So the second point is to track what's the maximum amount of money can be flowed in the retail space in one ticker. Now, the third one is track the average floated money being traded into a certain ticker. So every day you'll be experiencing different patterns, bounce short, gap up short, dollar block, and dip buy into bigger market caps, and also different variations of different patterns. And once you think the ticker is tradable and you want to track how much dollar is being traded in that one ticker, and once you track about 30 to 50, you will find out what's the average amount of dollar being traded in this type of pattern, and also called average floated money. And you want to take out all those exceptions when ticker is going to a full meme stock, going up 1,000, 2,000%, trading mass amount of volume that you have never seen before. So the average floated money is based on the daily basis that you encounter different patterns and you want to track how much money is being traded into that in that day. Now, most of the dollar block will be used in initial caps between 0 to 200 million for the market cap, and flow will be 3 to 20 million. And sometimes you will use it when an initial cap is 500 million to 1 billion. That we're talking about AMC and GME. Those are the two exceptions that happened in 2021. So, and 2020, and they do exist, but they are very, very rare. Now, if the initial cap is over exceeding $1 billion, that means a dollar block is unlikely to work, but there's still examples that happens, but it only happens maybe once every 3 years or once every 2 years. So it doesn't happen that often, but they do exist. Before I get into the average dollar block for different market cap and flow zone, I want to go over there's a difference between the overall market conditions. So as you know, that we went into a massive QE, which is money printing from the Fed, and giving stimulus checks to different retail traders, and they're putting money into the retail space, right? Then all of a sudden, that the stock is getting as max liquidity for small caps, and of course, when the Fed is giving out free money, that it will increase the liquidity for a small cap market. Now, in 2022, we launched QT, which is quantitative tightening. That means we're taking liquidity from the market. That means the average traded amount of volume and also dollar block will be dropping because people are taking money off the market and they're not going to trade. They're going to buy the essentials. So those are two, I would say, very different years. And one is pretty much all the way to the top. One is pretty much all the way to the downside. So once you get used to those, I would say, the limits of upside and downside, which is one is QE going upside, QT, max to the downside. And once you get used to those two different markets, I think to survive in the future markets, I think it's going to be very easy. And most of the time between 2016 to 2020 and 2021, dollar block normally gradually increased year by year. 2018 was 350 million, and 2019 was 400 million, 2020 was 500 million to 700 million, and 2021 was 700 million to almost 1 billion. But since we're going to a different market environment, that means the dollar block dropped largely because we went into QT pretty quickly, and we're doing QT pretty aggressively too. So we had a sharp drop on the dollar block for different stocks, and also average dollar block being traded on a daily basis. And the data was very stable between 2015 to 2021, but in 2022 was not stable at all. For me, I seen a gradual decrease on dollar block month by month. Normally you see it's year by year. And right now I'm going to give you the average dollar block for 2021, and also some of the average dollar block for 2018, because I think 2018 has a very similar small cap conditions compared to 2022. So I'm going to give you two of those examples. So it's going to be, you can use either one. When the market starts getting liquidity again, then use the 2021 dollar block. Then if liquidity still dropping, then use the 2018 dollar block. So we have two different solutions for two different market cap scenarios. So right here is the dollar block for 2021. You can see that the initial cap, it starts with 0 to 100 million. The dollar block on the intraday level is 800 million. Now for 100 million to 200 million, the dollar block for in the intraday level, but this has to be a multi-day runner for 1 billion to 1.5 billion. 200 million to 500 million is going to be 3 billion. But for especially only the first one, which will be 0 to 100 million, the intraday dollar block has to be 800 million. The rest of it has to be all multi-day runner dollar block. So 200 million to 500 million will be 3 billion, and 500 million to 1 billion will be 10 billion. Initial cap that's over 1 billion, as I said, it does not happen that often. It happens once every 2 to 3 years. So the dollar block is 30 to 40 billion. Doesn't happen. This is a dollar block that tracked from GME and AMC. And it does seem like once it formed that, it never exceeded the high, but it took a while to drop. So one of the dollar block for 1 billion plus is when it hits this type of dollar block, it doesn't drop like the previous 0 to 1 billion. It would take at least 2 months before it fades 50% from the top. So those are the dollar blocks for 2021.